Let's get to more market movers with easy-to-follow futures and options trades from CME Group.
Welcome to Market Movers. I'm Jim Iuorio, and today we're looking at the new Fed and what they might have in store for us in 2018. Now, the market says between 2 and 3 tightenings, probably 2.7-ish. I'm a little skeptical of that. We're going to be looking at risk assets and how they're going to be affected by the new Fed and its policy. Joining me is Chief Investment Officer of Kingsview Asset Management, Scott Martin.
Hi, Jim.
Okay. The Fed has kind of earmarked like they're going to tighten aggressively. We both know there are public pensions all over the country who need low borrowing costs to do. Is the Fed thinking about this? Of course they are, right? And can they tighten aggressively?
Nope.
Okay.
They can later on, though. I mean, here's what's going to be interesting about talking about the Yellen to Powell transition. I believe Powell is going to try to make this new Fed as much like Janet Yellen's Fed was at the beginning. But at some point, Jim, he's going to realize that the economic data is good. We have a possible passing of the tax plan now that seems to be going on, but is likely to get something done there in the next few months. So he's going to need to take on what I believe is going to be a more hawkish role for the Federal Reserve.
And I think what you just described is the sweet spot for stocks and many asset prices. New policy that's business positive and a Fed that kind of has their hands tied a little bit. Okay, here's the big question now. Was Janet Yellen an effective Fed chairman?
With respect to dealing with the ramifications and the fallout from the financial crisis, yes. But what she did not do, I don't believe, is eventually let rates get back to those normalized levels. I mean, we saw evidence that the markets, the economy have recovered, and the need to keep rates down for so long seems a little egregious to me.
So I think then baked in that is the answer to this question. Until we see the economy dealing with whatever normal rates are, we have no idea if Janet Yellen did a good job or not. The economy is still dealing with ultra low rates, yes?
Well, yes, and the 64K question there, to your point, is what are normal rates? Because is that GDP plus 1%?
I don't know, but it's certainly not what rates are now.
That's fair.
Okay, good. Now, before we dive into our trade discussions, I'd like to point out that as with all market movers, it's important to view these trades as examples that allow you to see different ways to use futures and options products to either manage risk or create additional trade opportunities, not as recommendations or advice. Prices and movements will vary in the market. Scott Martin.
So, looking at the ES today, specifically the week 1 expiry on ES, Jim, you know, we've got a market here that, again, is another day going towards outer space, it looks like. So, specifically, Jim, I don't really want to be, say, short this market or out of this market. So, I was looking at the 2700 27 call spread, 2720 call spread. It'll cost you about 3.5 ticks to put on. It expires, like I mentioned, on January 5th. But here's the interesting thing. It's going to cost you 3.5 ticks to put on. But I want to get this one maybe for a little less price. So, how about if I do this? I'm going to pay for this by selling a 2640 2620 put spread, my friend. Same expiry, January 5th for, guess what? 3.5 ticks. So this is going to risk you a little bit, as far as about $1,000 to make the potential fill out of the upward call spread, because you're going to have a potential 825 if it fills out that call spread. Thinking though, let's say the market goes up, or let's say it stays here, I get that exposure for practically free.
Okay, this will not surprise you at all. I remain a bull on this market. And I like, by the way, I can view this as 2 trades. I like selling that put spread, and I like buying that call spread. Putting them together, I think, is good. And yes, you risk some money on this trade, as you have risked money on bullish trades over the last year. They seem to work out, and there's no reason to play this.
3 possible outcomes. The market goes up, the market stays here, or the market goes down all the way through that put spread. Those first 2 scenarios work out for me.
Yeah, and I like it. I'm doing something similar without selling the put spread, but now that I hear yours, I like yours too.
Well, you can take the other side of it.
I'm looking at buying the week 1 Jan, the 2680 2700. So it's 20 ticks closer to where the market is now than where yours is, for 7.5 ticks. This trade expires January 5th. Underlying at the time was around 2670. This trade risks the 375 you put up to make a potential 625. Thoughts?
I agree with the exposure, and that is this market which has broken out to new highs, news of the day. But the reality is you're still getting exposure, I believe, for an effective price. And that's really what you want to do.
Right, and I guess realistically, the reason I've moved a little bit away from selling puts and put spreads is because the vol just keeps getting crushed. And I know it's worked, but at some point in time, it's not going to work. So I guess that's why I moved away. Thoughts?
I agree, and I think the other thing too about when you sell a put spread, I like to sell put spreads that are relatively close on the calendar, like we mentioned with January 5th expiry with this thing, a couple weeks away.
Like it. Thanks for joining us on Market Movers. I'm Jim Iuorio, where we're hoping to make you a better trader.